All right, well, let's get started. Looks like most of the people are still logging in. Thank you to everyone for tuning in tonight. Hello and welcome. We're so glad you can join us this evening and hope you're staying warm and dry in there, despite the cold and rainy weather outside at the moment. So whether you're joining us from your office or your living room or anywhere in between, the beauty about technology is you can tune in anywhere. We really appreciate your time this evening and for joining us in this topic of discussion about self-managed super funds. So over the next 45 minutes, we'll be basically having a general discussion amongst the four of us with some relevant topics, and the key thing is to highlight some information for you all to take away, such as the benefits and challenges of self-managed super funds, the considerations and processes involved when it comes to purchasing property through super, and a general property market update, as well as some trends and highlights that we're seeing in the current climate. So before we get started, just a friendly reminder, this is an interactive session between the four of us in terms of general discussion, and we'll go through the questions towards the end of the session. So the other item I wanted to raise is this information is general information only, so it's general advice, so that's our disclaimer. We're not factoring in any of your personal situations in our conversation tonight, okay? So, but if you do choose to, if you do have a question that might be relevant to your personal situation, feel free to reach out to us after this webinar, and we'll be happy to chat to you individually. So we've got plenty of valuable insights installed tonight, so settle in, get comfortable, and we'll get straight into it. I have the privilege of knowing the guys here for many years, and I'd like to introduce you to each guest tonight. So we have Simon Johnson from our senior finance and broker, Link Finance Group. Simon has provided specialised structured lending advice to many families and businesses over the last 30 years. This includes extensive knowledge and experience in self-managed super fund lending for both residential and commercial properties. Simon is well known in the finance industry as a subject matter expert in the healthcare sector and SME market. Welcome, Simon.
Thanks, Jeremy. Thank you.
Michael Osborne, Principal of Your Future Advice.
Hello there, guys.
Michael is a seasoned financial advisor with over 35 years experience in superannuation, insurance and mortgage lending. Michael's team are specialists in self-managed super funds and provide an all-in service to help make all things super and SMSF really easy. This includes financial advice, structuring, strategy, investments, insurance, also technical advice, legal, accounting, and auditing.
Pleasure to be here. Thanks, Jeremy.
And we also have Emma Allen, Director of Active Property Investing. Emma is the best-selling author and founder of Active Property Investing, or otherwise known as API. She leads a passionate group of consultants and property professionals who are recognized for their high standards in research and customer service. API has been nominated for many business awards, which include winning the coveted Australian Small Business Champions Award in 2024. Emma has featured in the Australian Business Journal's top 15 property experts to watch, and her team are passionate about financial literacy, and Emma shares her practical approach to help people from all walks of life build wealth through property. Welcome, Emma.
Thank you, Jeremy.
Guys, thanks for joining us this evening. I know you guys have a lot of experience and insights to both the property market and SMSF. So the purpose and theme of tonight is driven by one of the most commonly asked questions by our clients. Is a self-managed super fund right for me? So tonight we'll be exploring that through a series of questions which the panel will discuss. And I'll start off with perhaps Simon. What are the main reasons your clients are currently establishing a self-managed super fund?
Yeah, good question. I suppose a lot of the clients are looking to build wealth. They understand that investing in property is something that's tangible, and property is always an attractive option for clients. Clients may have already invested outside of super, so they may already have an investment property. Some may have purchased their first home, but the main reason is really building wealth. And I suppose with a self-managed super fund, it's a long-term strategy for clients. And as a finance broker, we're able to provide finance to help finance purchasing a property in super.
Okay, great, excellent, thank you. And are you seeing that amongst mainly consumer or business clients?
Across the board. At the moment, there's probably a little bit more activity with business clients purchasing properties. But in saying that, we do see both clients purchasing residential properties in super and clients purchasing business and commercial assets in super. So it's popular for a lot of our business clients, especially clients that want to own their own premises or set up longevity. Some of those retail clients, pharmacists, obviously owning their own premises is a good example. Yeah.
Okay, great, thank you, Michael.
Yeah, Jeremy, it is a good question. I think everybody probably comes from a slightly different angle. I kind of get the impression when I talk to most clients that they have a preference for property, and often the conversation is really about trying to take control of their retirement savings. Some people tend to express that they're just not sure whether the way in which their superannuation has been managed up until now is something they're satisfied with. And the other thing is that as the balances get a lot larger today, we're seeing a lot more people say that they're not as comfortable having as much of their retirement savings invested in the share market. So the idea of diversification is quite important. And what that means, of course, is that they're kind of able to sort of purchase the property and then have the remaining liquid cash left over. So it's quite a powerful way to somewhat de-risk in some respect because you haven't got it all sort of invested in the share market. It's actually in two different areas. And of course, the property asset doesn't sort of behave the same way as the share market. So that's kind of the sort of direction where we see a lot of people going.
So all about diversity?
Diversification often, yeah. Very much.
Okay, great. Emma, and what are you seeing amongst your clients in terms of the main reasons to invest in super?
I would agree with Mo. I think diversification is a really key part of it. But for us, SMSF is another vehicle structure that they can utilise. So, for example, if we have clients that are closer to retirement and they've got a shorter period of time, they tend to be more established, so they have equity behind them, they can go personal, and usually they've built up their SMS or their super fund balances. Therefore, transitioning to an SMSF gives them control, but it gives them two vehicles to be able to invest in. So they've got a shorter period of time, but they've got more capability to deploy both personal investing as well as SMSF investing. So I've seen it time and time again, especially in the kind of 50s as they're heading towards the latter end. It's less about time in the market, but more about how do I make the most of the 10 years I've got left working. And so by deploying two strategies, they've actually accelerated their ability to build their portfolio. So that's something that we see a lot. I think when the interest rates started to rise post-COVID, people's individual personal borrowing capacities were really squeezed, but people genuinely wanted to invest in property. So they started to catch on that SMSF investing is another vehicle that they can leverage. And so we could see that starting to happen in 2023. We probably did maybe less than 10% of our types of investments were SMSF, and that actually shifted the percentage to about 40% of what we were doing into SMSF.
It's a significant jump.
It was a huge shift. And as property providers and as a service, we had to really make sure that there was enough scope in our research capability to encompass solutions that were SMSF friendly.
Okay. And fast forward today, is that still the same sort of ratio?
I think it's close.
It's close.
It's probably sitting more like 30%.
Yep.
But it is very common now for us to have clients that have both personal and SMSF investments.
Okay, that's right.
And I think the assumption is that SMSF investing is very difficult, but it's not when you have the right people around you. It's a lot easier to execute. And I say this from a personal perspective as well. I couldn't have done it without my financial advisors and team around me.
Yeah, great point. Very
And
valid.
I think the other benefit is that, like Emma talks about the leverage, once people work out that when you're borrowing from the bank and you're investing and making another 4 or 5% on the bank's money, it actually really starts to talk in terms of the return on investment. And people say, well, hang on, we're not just making a return on our money, we're making a return on the bank's money. So it's quite different to a typical super fund.
Yeah. Okay, great. I'll start off with you, Emma. out of the clients that you see, what are the most common challenges that you find clients when they're trying to establish or purchase a property through a self-managed superfund?
I think they underestimate how complex it is to establish. Years and years ago, I had some clients that were accountants and they wanted to do it themselves. It's just wrought with disaster. That's probably one of the common challenges and pitfalls. You definitely have to have the guidance and advice. And I think legislative, it's changed now and you have to have your SLAs.
Your statement of advice, you do. Yeah, I mean, it's an ideal situation, but of course, some people can still go under an instruction only, and of course, as you've said, it's fraught with danger in terms of the complexities.
Yeah.
The other area I would see is they've come to us wanting to invest into the property, but then we have to kind of send them back to get the SMSF set up.
Yeah.
And if there's any advice, I would say talk to the brokers, to yourself or Simon first, because if they set it up and there isn't borrowing capacity and that's their intent, then they've set it up for nothing.
Yeah.
The other scenario that I've seen people come to us is that they have set it up and they've left it there as cash for years.
And it hasn't grown.
It hasn't grown and they haven't done anything.
Yeah,
so I think if you're going to set it up with the intent of investing in a property, like get cracking.
Yeah.
Yeah. You wouldn't want to just leave your cash sitting there.
Yeah, absolutely. Okay. And Michael?
Look, Jeremy, I think that, as Emma says, the complexities people maybe sometimes don't judge, they don't see it. And I have a client recently that's done it through an accountant, and it may simply have been that they'd instructed the accountant, and there's still possibilities there. The problem is that they rolled over all their superannuation, some 250,000. Their old funds were closed. The group insurance was gone. They hadn't set up a bear trust, so they didn't have that understanding that the second piece needs to be done. They had no idea what to do in terms of bank accounts, so they were told to go and set up a bank account with their standard bank. So off they go to the big bank with a bank account that earns no interest, and the remaining liquid funds that are going to be left over, they have no idea what to do, how to invest it. They're not really sure about other complexities as well. So it's fraught with danger. Yeah.
So basically like in the woods without a map.
I think that's the thing, is that you can sometimes question professional advice, I might have to pay fees. I think at the end of the day, you get what you pay for. It's better to work with professionals. Some of the other challenges we see in terms of setting up an SMSF is that there's people that are excited about it. They really are keen to go there, but they just don't have a large enough balance.
Yeah.
And I think under the old sort of regime, they were told to set up the SMSF. And like Emma says, they end up with the money in the bank earning not much at all. There's a right time for when you set up an SMSF. And at the same time, in terms of timelines, again, I've got people that sometimes they don't really have 10 years left before they retire. And it's a delicate decision as to whether or not an SMSF with a property strategy is right. So there are things that need to be considered. And again, working with advisors, we can work through that with a client to sort of work out whether it's actually in their best interest.
Sure. And you made a comment about not having enough balance to get started. Based on your opinion, what would be the ideal balance for a single or a couple?
Yeah, look, it's tricky. I think there's a little bit more risk as a single. I tend to sort of suggest to people that if you're single, you want to probably have ideally about 260, 270 now, because the mathematics sometimes doesn't work with the lending sort of scenario, and the price point sometimes can make it difficult if you don't have that sort of minimum balance. And for a couple, look, I normally try and suggest about a 350 balance. We can make it work with a smaller balance. It just depends.
Yeah.
So somewhere from sort of the late 200s into the early 300s is probably the bandwidth that you want to think about as a minimum when you start the conversation.
Okay, that's good to know.
Could I ask Mo a question? What are your thoughts about like family members joining, such as kids and their parents? So two generations.
Yeah, look, there's an estate planning element to SMSFs. I think in the main, particularly I have clients who will come to me saying, look, we're kind of thinking that we're going to do our retirement outside of super, and we really see our super as something that we can just leave for our kids, and they kind of start to think like that.
Okay.
They probably shouldn't. And I think depending on the age of their children, I mean, if they're adult children well beyond university into their careers and they're earning reasonable incomes, well, you can have up to 6 members of an SMSF under the law now. So I don't see any issue with that at all. We just had one client that had 3 members already, mum, dad and son, and they've now just brought in the daughter-in-law, and that's actually allowed the fund to go from having one property asset to 2 property assets, and another 200,000 invested in the share market on the side.
Yep.
So there's a right place for it.
Yes.
I think where the danger sometimes is that where mum and dad might think, look, can we bring our 21-year-old into the fund because it'll be better if we're all in the same family structure. It's not like a family trust. So I think that there's probably some of those people may be better off, those young kids, in the early part of their career, staying in their industry or retail fund and not being part of the SMSF.
Okay. And something to think about in the future.
Yeah.
Okay, sure. Simon, what do you see, mate, in terms of the challenges that a lot of your customers are facing?
I think the challenges, same as Emma and Michael, really people are struggling as to, well, where do I start? Where do I start? Who do I talk to? And I think both Emma and Michael have alluded to the fact that you've got to have the right people there in place. So you've got to have, a really good financial planner that's going to give you the advice. You've got to have a really good accountant that knows how to set up self-managed super funds and bear trusts. And you've also got to have good property experts that know how to find you the right property. From my side, I think a lot of the challenges that clients will bring to us is, what's our borrowing capacity? How much can we borrow? What does the purchase price look like? And then we can go through and we can talk to the clients about how much they've got in super, how much they're contributing to super, and then take it to the next step of reviewing that borrowing capacity. So I think where people do get stuck is they don't know where to start. As you said, sometimes they set up the fund and they put it in the too hard basket. They stop that journey, which is, can be very costly, because if your money's not earning the right amount of interest, or it's not in the right fund, or you don't have a strategy as to a timeline to when you're going to purchase a property, then it is difficult. So I think it's been covered, but those are the challenges that I see from a broker side as well.
Okay, great. We'll stay with you, Simon. So probably segue to the next question. In terms of the ideal timeline and sequence of steps involved for a client to establish a super fund and go through the journey of purchasing and settling on a property. I know you mentioned a lot of your customers would ask you about what the borrowing capacity looks like before taking that next step. So from that moment going forward, what's the ideal timeline and sequence?
I think ideally, look, if customers reach out to us initially as brokers, we can give them guidance and we can put them in touch with our partners to obviously help that process. I think from a timeline, for me to do a borrowing capacity, 1 to 2 weeks to gather the information, to give an indicative borrowing capacity to someone is probably fair. The next steps are then talking to the client about meeting with the financial planner. So, and that journey doesn't just happen in stages; it happens hand in hand. So, you can be talking to myself, and then you can be talking to Michael.
Correct.
So that we're working in tandem with that process. And once we've started that process, then you can talk to Emma and her team in regards to obviously finding a property. So, if I look at the timeline for an indicative approval, 1 to 2 weeks is fair.
Yep.
Gives us enough time to get the information from clients. To review the panel of lenders and work out suitable lenders and then suitable borrowing capacities. And then the next step beyond that, once you find a property, is our approval process. Now that approval process typically is probably about a 3 to 4 week process, allowing enough time to get valuations done and then getting the applications approved. But yeah, as far as a good estimate, I would say starting the process is about 1 to 2 weeks, and then progressing with us all during that journey and then moving through the approval.
All right, thanks, Simon. And then from that point onwards, once a borrower has determined how much they can borrow and knows the scope or range of purchase, I guess they'll probably speak to you, Michael.
Yeah.
What is the timeline and sequence of steps involved in your process when you're seeing a client that is quite excited to buy a property in super, having known what they can potentially borrow and purchase?
Yeah, I think, Jeremy, it's a little similar to what Simon said in the sense that we can actually work hand in hand with the broker in the earlier period. Sometimes the client might come to us first, or they might come through you guys as the professional brokers and then be referred to us. Because of the advice and the technical side of making sure that we help clients understand exactly what's involved, there's a best interest duty. We kind of try to say to clients that it's probably going to be about 4 to 5 weeks in terms of the advice and the setup of the SMSF. And within that 4 to 5 weeks, that would include that 1 to 2 weeks of the broker's sort of involvement. And then from there, it's that next step of talking to Emma and some of the property professionals. And I guess from that point, you also need to make sure that that first rollovers come in, because the SMSF without any money is very hard to exchange and pay deposit. So it tends to be that I always say to people, look, once you get past that 5-week period, it's probably another 2 weeks, sometimes 3 when the first rollover lands. So you can start the property conversation from about the 4 to 5 week mark, but you probably won't be able to exchange until the sort of 8 to 9 week mark, depending.
Yeah, sure. Okay.
And I know Michael and I have had discussions where, we get the client's permission. We've had internal discussions around where we think the budget's going to sit, and that works alongside Michael gathering information, myself gathering the information, us sharing that information to make sure we've got the borrowing capacity correct. Because I know, as far as running those calculations, more information we've got, the better result we can give clients based on budget.
Absolutely.
Sure. Okay, great. Thank you. And Emma, from your point, once the guys have sort of seen the client, provided the figures and the structure and the setup, when the client sees you, what is the typical timeline?
We always start with an initial consultation just to kind of understand the client's situation and their objectives and their background. I think that's really important for us. And because we're taking that step to really understand them, our process can overlap, as Michael mentioned, with yours. But we won't take the step of actually shortlisting and looking at live opportunities until they're ready. Because that would make sense, I think. But there's definitely a journey in my part of the phase for them to kind of familiarise with the market, to understand what it's like to invest with an SMSF. Often they want to explore a little bit of personal and SMSF as well. So I think that educational discussion can happen, just overlapping towards the end of what the two gentlemen are preparing. But definitely having the team, I've got to say, if you're an investor and you want to do SMSF, having to coordinate all of these people is really difficult. But if your professionals communicate with each other, it's so much easier. Because by the time you get into property phase and we're looking at properties and you decide to pick one, and we get into contracts and we're like, okay, what name do you want to put on the contract? They're like, I don't know.
That's a common question, isn't it?
And if they put the wrong name on the contract and that contract's executed, there's all sorts of, ramifications that are going to come as a result of that. And I think that's when someone who doesn't have the support becomes really, really exposed. And then from that point, the timeline kind of bleeds time, I think. So you lose the traction if you don't have the ability to just pick up the phone and say, Michael, what do I do? Or Simon, what does the bear trust? So it makes it a lot smoother if you've got that the connection between the professionals.
And that loop extending from Emma's information there is valuable to the extent that if we're watching what's going on with a client that's working with API or working with Link Finance, and we know, for example, that there's a valuation that needs to be paid for, the client will at that stage will be so new to SMSF, they won't even know how to pay for it from the SMSF. So they come to us and we set up the payment for them. Makes it so much easier. When the exchange, when the deposit needs to be paid, how do we get 10% out of our SMSF to pay this deposit? They'll come to us and it might be a holding deposit to start with. We'll get the information from API on the permission of the client and bang, we set it up and it's all done that day. And we then send the receipts back to the client and also the professional loop. So everybody's in touch. It makes it so much cleaner.
That's how easy it is to get wrong. Paying out of the wrong bank account.
And it's timing as well. As you said, it's the timing. I mean, it depends on the timing of the contract, or it might be a new build. There has to be a timeline around the indicative approval moving forward, and then when do I pay the deposit? How do I pay the deposit? And each of us, as a cog in a wheel, communicating with each other, just make sure that's a seamless process. Yeah.
But we don't want to scare people to think it's so complex that it's impossible to do.
Oh,
the benefits of it are fantastic.
Yeah.
And you just, for anything that's worthwhile, you have to do a bit of work up front. It's better to know what you're doing, have that smooth process, and then completely reap the benefits.
Yeah.
You can set and forget once they've got the investment.
Yeah.
So I think it's worth the effort if people are like on the fence thinking, should I do it, should I not?
Yeah, absolutely. And look, in a perfect world, that would be the sequence of steps, but not everything happens that way. Sometimes we see customers find a property, they fall in love with it, they want to pursue it under an SMSF. So it might start with you first, then everyone sort of falls behind and gets moving forward, right? Yeah. So there's no right or wrong answer, but as a guide, I guess there are certain time frames and sequence of steps. Yeah. Okay. Staying up with you, Emma, in terms of your clients, what type of properties are you seeing at the moment? Like, what are they sort of looking for to purchase in a self-managed super fund?
I think for me in particular, there is a bigger focus on residential. And so the question really becomes, sometimes people come to us asking for the higher yields with SMSF, but you have to keep in mind that you're also using cash as a deposit.
Yes.
So it's not just about yield, it's actually about the ins and outs, like a little business, and whether or not the super fund can hold the property.
Yeah.
And it's similar with normal personal investments. It's got to have a benefit. If it's going to cost you a bit, then the benefit would be the location or the demographics that live there or the type of growth that you're going to get. So I think for us, sometimes the discussion is around new and old, or new properties and existing properties. And again, they have their pros and cons as well. But if someone is looking for an investment that they can hold in their SMSF for the next 10, 20 years, because usually it's a longer term, it's not necessarily a shorter term, then a new property is easy to maintain.
Yes.
And they don't have to keep finding the cash in the super fund to fix things
improve.
and which they can't anyway, unless it's cash.
Yeah. Okay. Yeah, fair point. And Michael?
And I think the extension to that is most of the time we are usually dealing with mums and dads as investors. And mums and dads as investors are more familiar with the residential investment market, not so much commercial. So we probably sit 95% residential, 5% commercial in my client mix. And it's going to depend. I think that in the main, most people probably tend to prefer new. They like the idea that you can often get a better yield with something that's newer. It's more likely to be tenanted quite quickly. There's higher tax depreciation and less likely for anything to require something to be fixed or repaired in the first maybe 10 years or more. So that gives a lot of benefit there for the new. But at the same time, I do have clients that will look for something that might be possibly in a particular location or someone's recommended through a buyer's agent, and that's all fine too.
Okay, great. No, thank you. And Simon, because you see both sides of residential and commercial, what type of properties are you seeing at the moment amongst your client base?
Yeah, I do see a mix, residential and commercial. We probably see a good split, probably close to 50-50, because I do look after a lot of clients, and as you mentioned, in the healthcare space. So and as was mentioned before, I think a lot of those clients do prefer new properties just purely because in an SMSF, that expenditure is obviously a lot less, and a lot less as a cash drain. But if I look at residential, a lot of those investors are probably mum and dad investors, and the more sophisticated investors will look outside of residential, especially business owners that might want to buy a commercial property for longevity of the business. A lot of my business clients actually own properties outright. They've already bought the property as part of the retail trading business, if it's a pharmacy, the pharmacy premises, for example, or a GP, they bought the GP practice. And we can also have discussions with those types of clients as well about actually transferring that property into super. There's actually ways that people can transfer property in specie into super. That is something we've done a fair bit of work with a lot of pharmacists. A lot of pharmacists traditionally like to purchase the property because With that property, their pharmacy license sits within a certain demographic and location, so it gives them protection for that individual business. But yeah, not only people buying new properties, but people that actually hold existing properties can actually talk to us as well, because we could potentially look at funding it into super and moving it into super, which might be a more
more of a commercial property.
option for them.
Yeah. Okay. Great.
And I also think a lot of clients is worth pointing out that if they love property, which I think in the main is part of the world we all live in, we've got clients that love property, is that they'll often come to me saying that they can't borrow any more outside of their super. So they want to now use their super as that vehicle. And I think we all come from slightly different perspectives, but I always remind a client from my perspective as an advisor that buying an investment property is really the same as just buying any other investment inside their super. In other words, whether it's a government bond or whether it's shares or whether it's property, they're all investments for your long-term retirement savings. Everybody will have a slightly different perspective on that. And I always remind people, don't think of yourself as the property mogul by if you've already got one or two or three outside of super, this is the extra one. It actually legally is not really technically yours until you retire. So I just make sure that they understand that. Think about getting best bang for buck in terms of capital growth and rental yield when you're looking at that investment, the same as you'd look at with any other investment with your super. You want to make sure the return on investment is going to maximise the return on superannuation savings.
Yeah, great. Yeah, good point. Thank you, guys. I might pause here for a moment. We've covered the 4 questions we wanted to ask. Next up, we're going to have a property market update, and that's going to be presented by Emma. So she's going to talk about some of the trends and insights that she's seeing, and also an update on the current climate of the property market. So, Emma, we'll hand over to you.
Yeah, I think you hit the nail on the head when you said that anything inside your SMSF has to be treated like an investment. It's the same with property. I think when you think about the fundamentals that's going to drive the value of a property in your personal name, it needs to do the same in an SMSF. So the fundamentals of making sure that there are drivers for growth, making sure it's the right type of property that's going to really yield tenants and grow in terms of rental value, all of these are exactly the same inside or outside super.
Right.
So I think that's where the property market is going to have that commonality across the two. So in the last month, we've seen all of the capital cities move in the same direction. So post-COVID, there was a little bit of a trend where each city was in a slightly different cycle. And previous to this last month, the regional centres have actually been growing faster than the capital cities for the 9 months prior. So it's interesting how a slight decline in the interest rate has allowed more people to actively engage with the larger cities again. And so that really puts Melbourne and Sydney in good stead. And then you've got your kind of mid-tier capitals that is not quite as large, but we would have seen the Perths and the Adelaides and the Brisbane have a really strong growth as well. The regional centres are actually still doing well. And I think the disparity between houses and apartments is now over the 30% mark. So we're in a good position from a market perspective, especially with what's on the horizon and the anticipated rate drops, that are likely to come. So what we always talk about is, yes, you can see the statistics and you can see the direction, but what are the pressures that kind of push and pull on the market to create an environment where you can still capitalise on property? And so when we talk about the current environment, I think some of the core things we need to think about as a country is the sheer shortfall. We do need to build properties. I mean, the government had an initiative to build 1.2 million by 2029. Last financial year, so one before last actually, we were short 40,000. Now that's a deficit that we're going to carry. And by 2029, they just released the forecast. They anticipate we're going to be short 462,000 properties. Now, that leaves us in an even more dire situation than the market is now. Because if you talk to renters, they keep paying more rent. If you talk to investors, why is the property market so much more expensive than it was 2 or 3 years ago? Now, this kind of shortfall doesn't solve that problem. It actually makes it worse. And so when you look at the pressure of population growth, especially migration, their forecasts have been off again. So the anticipation was that migration would start to cool off after we opened our borders. We had the influx. It's now going to start to normalise to pre-COVID levels in the 200,000s. It's not. we're actually over 300,000. And so they readjust that forecast, but in actual fact, it puts even more pressure on the requirements for housing.
Wow.
So that is just creating its own little steam bath of what's likely to happen, which is why it's no surprise that rental growth has started to accelerate. And so rental returns grew 1.2%. Last year it was 0.5% this time last year. So that's twice the speed. It's picked up again. Interestingly enough, it grew by 2% in Melbourne.
Okay.
Yeah.
So that's interesting because Melbourne's been a little bit sluggish, but we're seeing some very big indicators on Melbourne moving again.
On a rental yield basis.
On a yield basis,
Yeah.
it's starting to catch up.
Wow.
Historically, Melbourne's usually quite low in terms of yields, right?
It
Compared
is.
to the rest of the states.
Yes.
Yeah.
And even so with Sydney. Melbourne and Sydney kind of were on par for a long time, but COVID really split the hairs in terms of which states kind of capitalised on it, especially Southeast Queensland, which is still going. So from a construction perspective, we look at how do we add supply and what are the costs and the increase. They are starting to level off. I think it's slightly different in each state based on various factors, but we do know that we have fewer starts. And if fewer starts mean less properties being built, from a developer perspective, it's pretty obvious that it's a harder environment. If you're an individual trying to invest in an expensive market, as a developer, it just adds risk. So they are very, very cautious as well, which means less supply again. And it adds to this conundrum that we're in as a country. Then you get interest rates cooling, and a lot of us are having a sigh of relief. It is a relief, especially since the cost of living is so high. And for a lot of people, that also means a lift in confidence. I can borrow that little bit more. It's now the time to go in. It feels better when the rates are low, right? But it also means that there's more people that are going to want to buy alongside you. And if that competition is there, then now we've got the shortage is even more severe and we're starting to get confidence and activity back. And we can see that as a service, especially in the last month.
So you've seen your phone ringing and people reaching out?
Yes. Interestingly, it's a lot of previous clients that have come back to say, okay, we're ready to go again because they've had that growth, they've had the lift in equity, and they're looking at what they can borrow and where to go next. But the conversation's so different because we can't go back in at 500 when those properties are now worth $1 million. We've got to look for the next type of location, and I think that's where you've got to think outside the square. Where else can I afford to make the most of what I have to replicate that level of success? So for us, it's exciting. For a lot of people, that means I don't know what I need to do and where I need to look. But I would always say follow the fundamentals, inside or outside of super. It's still the same property market, and you just need to be smart and well-informed when you make the decision.
Yeah, valid point.
Yeah.
Yeah, thank you, Emma.
That's
great.
okay.
That's great. And Simon, with rates coming down recently, and also a few months ago, are you seeing much activity from your end?
Yeah, I think there's definitely a lot more conversation, especially over the last month or so. People have started to re-engage. We've seen 3 rate reductions, 0.75% off. And it's not just, having an impact on home loan rates. It has an impact on the lenders' rates for self-managed superfund loans as well. Those rates have come down by 0.75 as well. So there's definitely more confidence and there's definitely more discussions that we're having. Prior to those rate reductions, I think probably the business and commercial side was a little bit stronger. People were a bit cautious on investing in property. Yeah, people were looking at renovations. They were looking at upgrading, but there wasn't as much on the investment side. Now there's a lot more conversation happening. Yeah, definitely.
That's great.
Which is
to
good.
hear. Great to hear. Especially if we're expecting another rate cut before end of the year, that's further going to accelerate people's inquiries and interest in property. I might ask Simon another question. What are the most common restrictions you see for an SMSF loan in terms of what are clients are able to do, and what are the policy restrictions with some of the lenders?
I suppose the biggest restriction on a lending side is for SMSF. You've got to look at a single title asset. So a single dwelling. It might be duplexes, and then you've got obviously two titles. So it's a single asset that you can look at in super. I suppose the other slightly challenging restriction is with super and investing in property. Residential and commercial. Each property has their own bare trust, so you can't leverage one property off another. They all have to be standalone. A lot of people get caught out where they'll, they might buy a residential investment property and then decide to pay it off really quickly and not put cash aside, and then think they're going to use that property to leverage the equity. Yeah. It's a big misconception. It's a big mistake that some people do make.
They do.
Instead of putting that cash aside, and I suppose that's probably one of the restrictions. Basic restrictions. Look, lenders will lend up to 80% as far as an LVR. That's both for residential and commercial, so they will go to 80% on the commercial front as well. There are some restrictions in regards to when a SMSF loan can be paid out. So most lenders will have a minimum of a 3-year period. So if you do pay out a self-managed superfund loan early within 3 years, some lenders might charge you, say, 3 months worth of interest up front. So there is some restriction in regards to paying out the self-managed superfund loans early. And then SMSF loans, you have to obviously invest in an asset. So you can't, you can't use those funds for personal use. And with older properties too, there's restrictions in regards to actual renovations. You can only do repairs, not full renovations.
Yeah.
So on the lending side,
and also on that too, I think construction is also one of the restrictions.
Correct.
Under super, you can't build.
Correct.
Entertain a construction loan. So that's one thing that a lot of people aren't aware of.
Yes.
But yeah, good point in regards to re-leveraging. You can't increase the loan and pull the equity out to buy another property. It just doesn't happen in super.
And another misconception that a lot of people and do ask on is in regards to new builds. So we can actually help people get into properties for a new build. I suppose it can't be a new build with a 1 or 2 or 3 year sunset clause. It has to have a shorter life term, but we can actually give someone an indicative approval and help them if a new build's coming up and Emma's team, for example, find a new build that's going to be completed within the next 3 to 6 months, we can definitely help clients get into those properties.
I think the key there is having a single contract rather than two contracts, one for the land, one for the construction. A single contract
You can do.
Spot on. That's exactly right. Yeah.
We've done a small handful of 2 contracts, but they've paid cash for the build.
Yes.
So that's a very, very unique scenario.
That's right.
Because they're not borrowing.
They're not borrowing.
They're not borrowing is the key.
Yeah, you've got to have that cash in your super to be able to do it. Yeah, that's correct.
But I just want to emphasise the point that it sounds, I feel like we're making it sound really difficult, but the reason why it is so heavily regulated and there are so many rules is because this is people's retirement.
Yeah.
And so the government is making sure that no one is abusing the funds that are set aside for their retirement. So I think there is a really good reason to why it is so restrictive. And if you can comply to all the restrictions, again, the benefit's there. But it is there. That's the reason. It's not because they're trying to make it difficult for you to invest in SMSF. It's actually because it is your retirement and they do not want to stuff it up.
And a lot of my clients like the rigidity of the structure that sits there, because if you're for example a business client and you're going to invest with a business partner and you're going to purchase a commercial property in super, then there's a lot of rigidity around that. That is a long-term investment. And there's a lot of structure put around equality of contributions. Obviously the accounting side shows what each individual member is going to be contributing. So there's really good accounting behind super as far as investment. And I say to a lot of my business clients, look, if you know your business partner and you know your business partner quite well, jointly investing in super and through a self-managed super fund is actually a solid way of giving longevity to that business. Because not only you might sell the going concern business, but you can actually still retain the property and receive rent when you retire or when you semi-retire from that business. So it is a good strategy, very good strategy. As Emma said, look, there are there's some real regulation around it, but the benefits are also very strong.
100%.
Yeah.
And it just goes to show having the proper professional advice really helps, just to keep it as simple as possible, right?
Yeah.
Michael, there's a question from the audience, Sally, asking what is the recommended minimum balance in super to start an SMSF? You sort of touched on it earlier, but can you sort of just elaborate on that again?
So there's probably two things. There's sort of the minimum super balance.
Yeah.
And there's also probably the right sort of incomes.
Yeah.
Because you got to remember that you need to have the right sort of level of super balance to begin with. And we sort of suggest sort of from about 260,000 or more. Ideally into the mid 300s would be a sweet spot. And above that is fine because you're kind of into the realm of being able to have choice.
Yeah.
I think as far as incomes are concerned, sometimes we find that people might have 320,000 in super as a couple, but they come to us and they might be on average incomes. And if they're on average incomes, that means the 12% superannuation guarantee levy is not going to be enough in the super fund for serviceability to borrow enough to buy a property.
Yeah.
So if I was to give people a rough idea, and I don't want this to be hard and fast because it's best to check with you guys first. You guys are the credit reps specialists. But I always say to people, you're probably better off to make sure that you've got a couple of $100,000 of income to make sure that your serviceability is going to allow you to borrow the sort of money you need to buy a property within an SMSF.
Yeah.
There's a couple of exceptions.
Yeah. So the borrowing capacity check is always a great start.
Correct. Yeah.
For sure.
And discussing, I mean, when someone says to me, look, this is the contributions we're making, I can have a discussion with Michael as well and say, look, based on borrowing capacity, if someone was making some additional contributions, we might be able to extend the borrowing capacity a little bit further, and then that obviously can be presented back to the clients to see if there is comfort and there is the ability for them to be able to do that as well. So.
And the commitment.
And the commitment. That's right.
Emma, back to you. What are the pros and cons that you see for new versus existing properties for a self-managed super fund?
Yeah, I think definitely the lack of, or the low maintenance, I should say, of a newer property is definitely a huge appeal, especially since, when you go to sell it in 10 years or 20 years time, it's still in good condition.
Yeah.
But it's mainly the holding costs, because older properties can tend to kind of hit that point where you have to start fixing or you can't renovate unless you've got the cash. Newer properties really appeal for mainly that. Now, there's no reason why you can't do an existing property. I think you just have to be really aware that there could be some cash flow impact on it.
Yeah, sure.
Because some people will think, okay, I'll buy an existing property, it's cheaper, but you just have to factor in the other side of it.
Yeah.
Because if the remaining cash in the fund might only be $50,000 when some people start, something may pop up. I won't specify a location, but there might be land slippage, there might be some sort of renovation that needs to repair that place back to its to be able to be rented again, right?
Yeah.
And if it requires $100,000 and there's only $50,000 in cash, it becomes a real problem.
Of course.
Yeah.
Absolutely.
But it could be something that's almost completed, so it doesn't necessarily have to be off the plan.
Yeah.
So I think it still comes down to fundamentals. It's got to be in the right location with the right type of tenants, and in a tight enough market that it's going to grow. Because ultimately the fund wants to achieve both. It wants to have the capital growth, but it wants to have that constant cash flow. So I would caution anyone that's going to be kind of seduced into locations to get high yield but no growth.
Yeah.
Likewise, if it's going to cost you something, then have a benefit like the stronger capital growth.
Okay, great. Thank you. There's a question from the audience, Madrid. Would it be better to invest solely in a residential property through super, or should we have a mixture of both commercial and residential?
So if I could answer that first, just from the perspective of what the client's trying to achieve, I think they both have their merits. One of the things that people often ask me is it better to buy inside super or outside of super? And it'll depend, but largely from the perspective of if there's any tax benefits in terms of negative gearing it's probably going to be better outside of super if they can do it that way.
Yeah.
So if property's their preference for investment, lean to outside of super first. It's probably where they want to look because the tax benefits will be there based on their marginal rate. The superannuation environment's only a 15% tax regime. So although there's still some benefit within super, it's only to the tune of 15%, not to the tune of 47 or 39 or 32 outside of super.
Right. Okay. No, that's great. Michael, in terms of long-term retirement planning benefits or risks of holding property in a super fund, what's your view on that?
Look, I think at the end of the day, as a financial advisor, I've been doing this for a long time. I've seen clients have so much success. I think the benefit of holding it for the long term is purely the fact that there's a capital gains tax exemption when you get to what we call pension drawdown age. So once you get into the retirement phase, you'll be able to sell the property inside the super fund and not pay CGT.
Okay.
So it's a massive advantage. I think that's probably the starting point.
Yeah.
But even if you're in accumulation phase, so you haven't retired and you sell property in super, how does that work?
Yeah, it depends on age because there's different rules for different ages once you go above 60.
Yeah.
So you really just need to make sure that you qualify for the CGT exemption, which usually is going to probably kick in from more like 65. I think that if they were to look at selling the property, because some people will say to me, oh, what happens if I've bought a property and it's just gone gangbusters over a 6 or 7 year period, and they might sort of sit there going, hang on, we're only 50, but we're not sure the next 5 or 10 years that market's going to perform as well as what it has done. It doesn't mean they can't sell the property prior to retirement. They're just going to pay some capital gains tax. And the good news is that it's a little bit cheaper than capital gains tax outside super. So inside super, you're subject to 15%, but as long as it's been held for more than 12 months, which would be most common, you get that discount back to 10%.
Okay.
So there's just a 10% capital gains tax that they'd be subject to.
That's right.
And so for some people, they might sit there going, if they're clever enough to pick the market, and we always say to people that's hard to do, maybe there's some moments for a client where if they know the market well enough, they could sell out and pay a little bit of CGT and go into a market that's on the rise.
Okay.
Yeah.
Sure.
Interestingly enough, though, you're buying and selling still in the same kind of market.
Yeah.
That's the challenge.
Of course.
And then you have selling costs and then purchase costs again.
Of course, yeah.
Yeah.
Yeah, we tend to talk to clients about it's really a buy and hold, and as advisors we're very much talking along that. And the long term, you obviously want to hold it long term to cover the acquisition cost.
Yeah. And are there many strategies available for clients looking to raise the super balance to get into the market? So if they don't have quite enough there over the next year or two, they plan forward with professional advice. There must be some sort of strategies available, right? To help.
The most simple is if you're serious about your fund, you want to put more contributions in. And people might think, hang on a minute, we don't really have the sort of surplus income to do that.
Yeah.
What people don't realise is that if they have an amount of money, for example, and they're offset, and I'm not going to talk, this is general advice, there may be opportunities to grab some money out of their offset on the basis that interest rates are coming down, so it's not going to impact them as much. They're not going to save as much by having as much in offset, but they could get a very serious tax deduction by putting a lump sum into super. And we've seen clients recently put in $50,000, $60,000, $70,000 from their offset, get a full tax deduction on that entire sum, and it's taken their balance from like 270, 280 up to 350.
Okay.
Yeah, so there's certainly opportunities there.
Okay, that's
I mean, people need to reach out and ask.
Yeah, of course. Yeah.
But there's no magic, unfortunately, in most cases. It's not like we can invest the money somewhere and suddenly double it overnight.
The money has to come from somewhere.
It's got to come from somewhere.
But as you said, a lower interest rate environment makes that a little bit more appealing.
It does, yeah.
Question from Kate. If we are purchasing land and build a new home and our contract is split, can we use super funds? So I think we sort of touched on that earlier, where you can borrow for the land and then use your own funds in super to construct, as long as you don't apply for a loan because you can't get a construction loan.
Yes.
Right?
Yeah, correct.
Yeah, that's correct.
And another question here, how easily can I adjust my super fund strategy and structure if my personal or financial circumstances change significantly?
Yeah, so, I mean, the first thing I always say, remind people of, is that their personal world of finance is sort of on one side of the table and their superannuation world is on the other. So it's very, very important when we're looking at structure to make sure that the superannuation fund, in terms of the direction and the strategy, is going to hold up. You don't want to have a situation where everything's so tight on the superannuation modelling that it requires potentially extra contributions if the client doesn't have it.
Okay.
So broadly, there's no real crossover. We're really looking at an ideal situation that we can set the client up and the whole super structure is sort of self-sustainable with contributions and rental income. And we work through all the risks and all of the what ifs. But at the same time, there are going to be there's always a risk that they might require contributions in certain circumstances. It would be unusual.
Okay.
It would be unusual.
Okay, great.
Investors really like that though. It doesn't impact their family cash flow.
Correct. And it doesn't affect your borrowing capacity either.
Yeah.
So and there's also, I get a lot of clients that come to us, this is a good point for the audience, they'll come to me and they'll be at that point where they're really, really keen and they've actually got capacity outside super and they've also got capacity in super as well. And I always tell them there's actually a right order to do it because as you know, Simon, and the guys at Link, is that if you go to the lender and you're in the middle of doing an outside of super transaction, when you then go to the lender in the same sort of time band to look at something inside super, they can actually ask more questions. So you probably tend to do the super transaction first and then go and do your outside of super transaction. That's our broad recommendation to people. I mean, we obviously push them back to you guys for the advice. But.
Yeah, sure.
And the good thing is that it's a fair point too. Look, the good thing is most lenders will ask us, what is this application for? There'll be a credit inquiry as far as the application.
Right.
And it's quite easy for us as brokers to explain it's self-sufficient, it's within their self-managed super fund. So it's not going to impede clients by doing the SMSF.
Okay, great. Guys, thank you. I think we've just about hit the 7:30 mark. I know people have probably other commitments or other things to get to, so we'll wrap it up. Great conversation. For everyone out there, an email will be sent out with a feedback form. Just let us know your thoughts, or if you have any questions, please complete the survey. So if there's anything that you guys want to discuss, if you feel like you want to reach out to either one of us, on that email there'll be a nomination for you to get contacted. So if SMSF is right for you, let us know. So I'd like to take this opportunity to thank our guest speakers, Simon, Michael, and Emma. Thanks for sharing your insights and your experience tonight.
Pleasure.
Thank you for having us.
Yeah, very much.
And thank you to our marketing team, Pearl and Rach, for all the work you've done behind the scenes to get tonight happening. And thank you to our audience. Thank you for tuning in. I hope you found the information educational and of value. And hopefully it assists with you making the right financial decisions, whatever pathway that might be. So thank you again, and have a good night.